I'm Jane King for Smart Money Matters. Thank you for being with us. We're here with Laila Pence of Pence Wealth Management, a 30-year advisor ranked as a top advisor by Forbes, Barron, and the Financial Times. Welcome, Laila.
Thank you, Jen. So happy to be here.
And we're talking about the new tax law of 2018 and the impact of the overhaul. And one of the biggest changes involves itemized deductions. So can you explain that?
Absolutely. Itemized deductions have changed completely. They have now really been replaced by a standard deduction that's been doubled to $24,000 for a couple filing jointly. But a lot of the deductions have been limited as well. No more unlimited state income tax deductions. State income taxes and property taxes are now limited to $10,000. Interest expense on home mortgage is now limited to a loan for $750,000. No more home equity lines of credit. So you can't borrow just to buy a car anymore and deduct the interest. It can only be interest that's used to buy a house. And then the miscellaneous deductions, they're gone. No more deducting CPA fees, investment fees, or unreimbursed business expenses. It has greatly been limited.
Yeah, those are some very big changes. And let's talk about charitable deductions. How have those changed?
Now, actually, charitable deductions, one of the things they left. As a matter of fact, they actually increased it. For cash deductions have been increased to 60% of your income. The problem is, let's say you're a retiree now, and you do not have a home loan. So you can't deduct any interest, and your property taxes and state income tax is $10,000, and you're used to giving $10,000 a year to charity. Well, now that $10,000 is really not deductible anymore because you automatically get $24,000 standard deduction, and you're used to giving $10,000 to charity every year. So one of the things that we are telling our clients now that they really should consider what we call a donor advised fund. It's a fund where you can bunch up your deductions. So instead of giving, let's say, $10,000 every year for the next 4 years, you can give the whole $40,000 in 1 year, put it into this fund. Okay, now you're able to get a bigger deduction because you can itemize. And then this fund, this money is invested, and then you can give it to your favorite charity when you want to and how much you want to. You can spend it over the next 4 years. But it actually gives you a chance to get benefit from your tax deduction because we really encourage people to give. It's a wonderful thing to do.
Mm-hmm. Okay, very interesting. Now, what about the impact to real estate, both residential and commercial?
So for home ownership, the fact that the interest deduction is limited and the property taxes are limited, in California, property taxes are very high. We do think from the standpoint of taxes, home ownership may not be as attractive anymore. We think a lot of the younger people will start renting. However, for investment real estate, when it comes to residential and commercial real estate investments, you buy it for investment purposes, that actually has improved because it's now considered as a small business. And as a small business, it could be eligible for having 20% of the income tax-free.
Wow.
So it's a big benefit, and we do think that's going to encourage more investment in real estate when it comes to investment in real estate as opposed to just ownership.
Interesting. Okay, and then education savings, 529 plans.
I love 529 plans. They're my favorite. In the past, they were only used to pay for college education on a tax-free basis. But now, for the very first time, you can use up to $10,000 tuition. You can take out $10,000 to pay tuition for elementary school and high school. So they made it a lot better. And of course, this year, the amount that you can give someone has been increased from $14,000 to $15,000. So now you can give more into these 529 plans and have them grow tax-free. Okay. I love them.
And big changes with the estate tax.
Huge changes. The exemption there has doubled. So a person now can give $11 million to their heirs without paying any state taxes. A couple can give $22 million to their heirs without paying any state taxes. However, that exemption expires in 2025. So we are recommending to clients that have large estates to maybe take advantage of the exemption we have now and maybe gift to their children now as opposed to waiting and have that exemption go away.
Okay, lots of changes in 2018. Thank you very much, kind of breaking all that down for us. Laila Pence of Pence Wealth Management, thank you, of course, for helping guide us sort through all of these changes. And I'm Jane King with Smart Money Matters.